Bond duration is a concept that often confuses new investors. It is not just about time, but rather a measure of price sensitivity. Think of duration as a gauge for how much a bond's price will swing when interest rates in the broader economy change. If a bond has a duration of 5 years, a 1% rise in interest rates typically causes that bond to lose 5% value. Several factors play into this calculation, including how long until the bond matures and how often it pays out interest to the holder. Investors balance these trade-offs. Shorter duration bonds are more stable, while longer ones react more sharply to market rate shifts. This chart shows how duration compounds risk. A 30-year bond is significantly more sensitive to interest rate hikes than a 2-year bond. Use duration to understand your portfolio's exposure. It helps you align your investments with your personal tolerance for price swings. Thanks for watching. Remember that bond markets are complex, so always do your own research. Subscribe for more finance basics.